backbone of trade, and that is, of course, infrastructure. And I think, Minister, it was certainly unfair of me to add another portfolio to your Department of Trade when there are so many projects and so many ambitious goals that you have alluded to. And thank you so much for that address. Ladies and gentlemen, might we honor the Minister with another round of applause for the ministerial keynote. Ladies and gentlemen, I now have the pleasure to moderate our opening panel discussion that is going to delve into the impact of macroeconomics as well as geopolitics that they have on African trade and investment. And what we've been tasked with is to not only investigate, but to also remain true to the theme of this year, and that is to unlock the opportunities that are going to be engaged throughout the course of the next 2 days. And that is, of course, to the Minister's note, to unlock the true potential and the growth potential of the African continent. We have very capable panelists who are going to be navigating this critical conversation, and I'd like to call them upon on stage. Our first panelist is Gabrielle Reed. She's the Head of Advisory for Pangea Risk. She'll be followed by Atul Jain, the Managing Director and the Global Co-Head of Trade, Finance and Lending at Deutsche Bank. I'd also like to call upon Julie Coulon, the Director of Head of Trade and Corporate at EcoBank International. And rounding off our panel discussion, Marc Oubois, the Counselor for Economic Research and Statistics Division at the World Trade Organization. Might we give them a round of applause, ladies and gentlemen? And of course, excuse our Minister who has to depart. Thank you so much. Might we give the Minister a round of applause as he exits, and of course his delegation, thanking them for their incredible contributions. To my panel, thank you very much for being a part of this conversation. And I think before I invite your opening remarks, I do want to note to our delegates that through the last 10 to 15 minutes of this conversation, we are going to open the floor to your questions, and you can submit those questions via the GTR event app, and that is how we would like you to incredibly participate in this conversation. Now, Gabrielle, I'm going to start with you. When we're looking to Pangea Risk and the intelligence that you engage and work with, it's not only looking to forecasting, but it's also looking to mitigating. And before we can harness the opportunities that we're going to be talking to throughout this conversation, paint us a picture of the current headline trade trends, as well as what they look like when it comes to the trade and investment ecosystem.
Great. Well, thank you, Vuyo. And before I start, just thank you to GTR Africa and the various sponsors for the opportunity to participate in this discussion. Not an easy question to answer, particularly in the current geopolitical climate, but I will try my best. Before I sort of get into it, I'd just start with a caveat that there's always nuance in different sectors and in different countries. So when you take a 30,000-foot view of what we're seeing in Africa, it is important just to remember that. But there are a few trends I think it's useful to put on the table to drive this discussion. The first one is we are seeing trade realignments off the back of some of the geopolitical shifts we've seen recently. We also see great growth opportunity for intra-Africa trade, but there are some downside considerations, specifically persistent issues over governance and political and security issues. So I'll just get into those a little bit more just to guide the conversation. I think firstly and most critically, we are seeing African countries rebalance their trade relations. Now, I think there's been a lot of attention, a big spotlight on this in recent weeks based on some of the posturing coming out of the US. But that trend has actually been ongoing for a lot longer. Now, that's not to say that traditional Western partners are not important. They definitely are. But there's new players on the team. The likes of China, obviously been around for a while, but increasingly India, Turkey, and the Gulf states. And we're starting to see this come out of trade data, right? Something like merchandise exports. If you look at where China and India are now, they account for around 23% of those exports for Africa. Back in the 90s, that was about 8%. So you definitely see the growth. I think the Gulf states are having a big impact. Saudi, UAE, Qatar, but together with Turkey, they've invested over $100 billion on the continent in the last decade, 53 billion of which was in 2023 alone with foreign direct investments. What's really interesting here is, yes, that's part of the Gulf's agenda to diversify their domestic economies, but where they're investing, the sectors that they're supporting, agribusiness, ports, logistics, it's actually going to open up and address those infrastructure limitations that Africa is facing and open up new trade corridors. Intra-Africa trade, absolutely growing. I think it's growing at a rate of around 7.2% year on year. And this is fantastic. We're really starting to see excitement around the initiatives around the Africa Free Trade Continental Agreement, and it's having the impact. The UN Economic Commission on Africa has estimated that intra-Africa trade is due to increase by 35% by 2045. And I think that really speaks to some of the opportunity on the continent. There are some downside risks, unfortunately, and I think it's important that we have an honest conversation about them. And these really speak to things around weak governance and political volatility. I'm not sure if anyone on the panel or in the audience has read the results of the latest Afrobarometer 2024 survey, but some of the findings are a little bit sobering. Now, of the 39 countries that they survey, only about 30%, so that's 3 in 10 Africans, believe that their governments are doing a fairly good or a good job when it comes to key critical responsibilities, job creation, and management of the economy. And that's not necessarily a good story. There are winners. I think there's countries that are doing wonders in terms of improving their governance. Côte d'Ivoire is often sort of pulled out as a case there. But if we look at governance trends elsewhere on the continent, over the last decade, they've either stalled, and in the worst case, they've gone backwards. An interesting statistic I often use is between the years 2000 and 2022, there's been 123 forceful changes of government or extreme changes of government where you've seen almost a complete regulatory rework from the prior regime. And that brings a lot of instability and a lot of uncertainty for investors that has knock-on effects on trade as well. So those are really issues that need to be addressed in order for Africa to take advantage of the opportunities that lie ahead. The green energy transition is going to be critical for those opportunities, but I think African countries need to do a bit more to unlock that.
Absolutely. And we're going to be coming back to quite a few of those triggers, including the Global South and the consolidation that we have been seeing. But Mark, I want to come to you and just extrapolate on some of the data and the narratives that Gabrielle has painted, and particularly when we're talking to the resilient measures that we're going to have to adopt in order to de-risk and to mobilize this economic growth.
Yes, thanks very much, and thank you for the organizer to invite me. I think I've been doing GTR MENA a couple of weeks ago. I'm very happy to be here. I'm going to do GTR Asia, so I'm going to travel around the world thanks to GTR, and I thank the organization very much. I would like to support exactly what you said right now. We're closing in on the numbers for trade in 2024, so I had a remote meeting last night. The WTO is closing on these numbers. And year 2024 was not bad for international trade. It has been growing about the level of the growth of global GDP, which was around 3.5%. And so this is what trade would have been growing in goods and services, right? Goods a little bit less than that, but we're still around 3%, which has been the average of the past decade. And despite the pandemic, despite the supply chain snaffles after the pandemic, despite the Red Sea and the war in Ukraine and all of the risk we have seen and now the geopolitical fragmentation, trade keeps growing by 3% a year in every year over 1 decade. And that means that if you grow anything by 3% for 23 years, you're going to double it. And here I'm only talking about volume terms, so deflated terms. So if you are looking actually for trade right now in US dollars, you would be above 25% above pre-pandemic levels. So, for example, just to give you an example, global trade in goods was probably last year $25 trillion in the world. It was 19 just before the pandemic. So this is good news, and developing countries are growing twice as fast as developed countries in this growth, and therefore we see that Africa has been a little slower to catch up for various reasons, but now it's catching up on the growth of trade vis-à-vis other developing countries, and there's good reason, pull and push factors. In the pull factor, you have the European Union, which remains an important market for Africa, and in the past 2 years, actually, and that was still the case last year, the imports of the European Union have been both in volumes and in value declining. So that's that. But as you have been saying, the push factor are the markets in emerging markets. Indeed, India, China, although China's domestic demand is a little slow. But two things I would like to bring your attention on. The first one is, as you said, over a generation, I have seen intra-African trade growing up from 9% to 18%. So it's been already doubling its share, and we're also pretty positive on the expansion of that intra-African trade. The second thing, which is very less well known, is the fact that 30% of Africa's exports now are supply chain exports. Now, don't forget one thing about international trade: 50% of international trades are parts and components. This is supply chain trade. And this is growing. So 10 years ago, it was about 40%. It is now 50%. And 30% of Africa's trade is not just raw materials, but already the first level of what we call intermediate goods. So this is ferrous metal, this is fertilizers, this is car parts. I can go on a little while. First level of transformation, but we already see that. And this is more and more important. So actually, Africa is getting on into supply chains. Now, with huge potential, of course, when it comes to critical minerals. We see a huge demand for, at the present moment, for electronics goods. Do you know that the vacancy rates on international servers is only 3%? So there's a massive investment at the present moment on electronics, servers, computers, microprocessors, and of course the critical materials are here. Same for electric vehicles. The critical materials are here as well. And we can see, for example, Africa growing as a part car maker over time.
Thank you so much, Mark. And we're going to be a bit later on just unpack some of these concepts as well that are certainly contributing to the pace of growth that we're experiencing on the continent. And before I move to you, Atul, I am going to ask the team to just close the doors so that we can just manage the noise pollution. I think also just from an AV perspective. Thank you so much. Atul, let me lean into your 25 years with Deutsche Bank, working across emerging markets like the African continent. When Gabrielle and Mark are talking to these triggers and these factors that are contributing to the pace that is being impeded to de-risk and to contribute to the growth of the African market, how influential do they become when it comes to structuring the finance and those zeros on the checks that Deutsche Bank signs?
Zeros at the end, not at the front. Thank you for shutting the doors so no one can leave. I'm thrilled to be here. This is my first time here, and I'm really excited for that. Actually, it's good because we can disagree, right? That's the whole point of a panel. So I think the challenge we have is that I'm a bit of a data nerd. We use data, obviously, a lot in writing checks. But there was this term coined after the pandemic called VUCA, which is volatile, uncertain, complex, ambiguous. And that's really kind of been a red thread through the past 5 years. And if we were to look, again, and this is as a corporate bank at the continent, and I was relying on data, this would not be the best time to be writing checks. From a macro perspective, we've seen a number of sovereigns re-rate after the pandemic. We've seen a number of foreign banks withdraw capital, and in some cases physical presence from the continent. We still see, while supply chain diversification and supply is obviously high, a very large share, so more than 60% of export earnings rely on oil, gas, minerals, things that are still very volatile and subjected to global markets. You'd made the comment earlier, both of you, about infrastructure, transport, energy, communications. It's still got a long way to go. Trade on average on this continent is 50% more expensive than anywhere else in the world. Transport alone, accounts for 63% of that delta. So there's a lot of work to do from a macro perspective. The micro piece, which is quite interesting, because I'm seeing my team there, that's why I'm looking that way. But I've been coming to the continent a bit more over the past few months. The micro perspective is also interesting because there are very few regional champions or large local corporates dominating the continent. It is a very SME-led economy. They account for over 80% of employment. And so a lot of these pain points, FX volatility, infrastructure gaps, access to credit, really pinch. Even when I think about it from a trade perspective, most of the way SMEs finance themselves is largely through overdrafts and mortgage loans. And then that brings us to kind of the trade perspective, which is to say, again, a lot of this data is being prosecuted by individuals sitting far away from the continent. And so it's very easy to be misread or misunderstood. Running sovereign downgrades, kind of infrastructure gaps, volatility and kind of input prices through the system would lead to some very negative outcomes in terms of allocation of capital, certainly on a risk-adjusted basis. Nonetheless, when you look at it in real terms, and that's really what we try and do, and that's why we're on the ground, trade has held up remarkably well as an asset class across credit cycles. Even now, as sovereign debt and loans are being restructured, trade has held up remarkably well. So we use data as an input. I guess that's now really coming to the crux of your question. But finally, we're looking through that data and taking a bit more of a strategic decision on how we want to view the continent. Long term, the structural drivers are very much in place, exactly as was just mentioned, be it on the demographic dividend, be that on the rich resource space, be that on the promise of renewable energy and digital infrastructure, be that on the growing intra-regional trade, as was mentioned by both panelists. So that's what we try and do. We've been sustainably on this continent for nearly 70 years. We're a very large correspondent bank globally and specifically in the continent. We've tried to increase our partnerships also with DFIs to bring capital to work in the continent while others have pulled back. And while I'm globally responsible for our trade finance business on the working capital and documentary credit side, this is my third trip to the continent in 6 months. So it's really important for us. And I think that's the kind of long view people need to take or look through in spite of what the data may be suggesting in the short term.
Absolutely. And perhaps as a follow-up, what then would be the kind of data that you're looking towards, mentioning that now wouldn't be the best time to actually continue those checks?
I think for us it really comes back to a little bit what Gabby had mentioned, really in terms of what do our clients need? What are they looking for? Finally, we exist for our clients. I think the commentary around Europe and the US, we've certainly see a bit of a scale back there, but they're still a core client base for us. Chinese corporates, and then increasingly Indian, Turkish, Saudi, UAE, Japanese clients are really kind of taking a large share of whatever we've seen retreat from the developed West for various different reasons. I mean, in the context of India, and I was there last week, we see a lot of equipment production, consumer goods, pharmaceuticals, and in many cases, MNCs producing equipment in India for the African continent to create a competitive advantage on cost. Turkey was mentioned. I mean, they have phenomenal strategic competitive advantage in core infrastructure, so buildings, bridges, ports. And so, as the minister had mentioned, infrastructure is really the need of the hour. They found a strategic sweet spot. Saudi is obviously looking to secure commodities, to diversify their domestic economy away from oil. The UAE has become increasingly a bit of a gateway or a nexus into the continent, both for regional treasury centers and sales offices. So our logic is to really follow our clients, follow the themes, renewables, energy, 5G, ports, logistics, food security, and then where those circles kind of intersect, in a Venn diagram context, that's kind of our point of value, and that's the data we look through. Because as I say, at a macro perspective, it is a continent. I mean, I sit in Singapore. I hate when people talk about Asia Pacific. Asia Pacific is, a conglomeration of many different cultures, languages, economies, and I feel the same about Africa. So, for us, it's really important to look through the data, as it were, and really kind of look at what our clients are asking us for and how they're holding up.
Absolutely. And as we speak to payments really following the infrastructure, trade does so as well. And Julie, I want to bring you into this conversation because when we're speaking to trade is also digitized. And one of the ways that Ecobank has done so is by following the initiative of the AFCFTA and looking at how do we better stimulate the facilitation of trade with the various stakeholders on the continent. And one of the ways in which Ecobank has done so is through the single market trade. Talk to us a bit about the decision of that particular platform and who it ultimately benefits as well.
Okay, thank you very much, and thank you to the organization for inviting me. So indeed, AFCFTA is probably one of the ways to increase the intra-Africa trade. We at Ecobank, we have launched the Single Market Trade Hub, which is a matchmaking platform which allows trade actors in Africa to meet and to generate new business opportunities. With this platform, we try to facilitate the intra-Africa business. We also share our expertise in terms of AFCFTA and in terms of African countries. And we also offer our products in terms of trade and payment solutions. I have the example of exporters, for instance, SMEs, which are selling painting goods or vintage textiles, which have been able to export their product in other African countries thanks to this platform, which would probably not have been possible without this platform. And what is interesting is that with this platform, we do not only address large corporates, but also SMEs, which are probably the ones which will need the more support if they want to take advantage of the AFCFTA. At Ecobank, I think this is our contribution to the AFCFTA. Today, we have more than 8,500 exporters and importers in Africa, which are already profiled in the platform. So it shows the huge potential for the growth of intra-Africa trade.
And we're going to come back to that conversation about intra-African trade. And I think also something that Africans do really well is group economics and doing things together so that we can go farther. But I do want to swing the pendulum back to you, Mark. We've begun to paint this canvas in understanding what's going on, but also looking at what is impeding us actually activating or unlocking these opportunities for growth. And one of the conversations, or I suppose the critical components of this conversation, is disinflation. Talk to us a bit about that and why it would be an injustice to leave this concept out of this conversation.
Yes, I'm a macroeconomist by training, and we do the forecast in the WTO on trade. And one element that is very important to us and is sometimes underestimated is the impact of inflation on trade. And let me explain you why inflation has been so important. So in 2023, basically world trade has been flat. That's because net disposable income of people around the world have been taking a hit as a result of inflation. Now, world trade is made of 75% of goods, right? But our consumption of things is 10 to 15% of goods, and the rest is services, right? Our services bills are incompressible. This is, our utilities, this is whatever, rentals and so on. But what if there is inflation and our income is eroded? What happens is that we tend to push back or delay our consumption of manufactured goods, whether it's consumption goods or capital goods for companies. So that's exactly what happened in 2023 with a flat global trade. That was the impact of inflation. So our projection was for 2024 is that inflation would abate, and as a result, people would recover. As we were seeing, by the way, in the world, wages would catch up with lost or eroded net purchasing power. And that's exactly what happened. And you see a rebound of manufactured goods. And for 2025, we do foresee the same. Why? Because actually disinflation was the fastest in the developed countries, which growth of trade is smaller, right? So that has already kicked in 2024, but now inflation is very close to the targets of central banks. But inflation remained relatively elevated in developing countries where the potential for growth of trade is the highest. Therefore, we expect disinflation to actually kick in faster in the developing countries, and we do see probably in 2025 disinflation happening and therefore being favorable for trade in developing countries. Also hoping that, of course, with the disinflation, interest rates would go down. Of course, the big flip side is, you know, trade policy uncertainty. But what I would like to say about this is a point that you made just before, is that in terms of Africa, also what's very important is trade costs. As you said, the trade costs are still very high. They are the highest in the world. We have a trade cost database in the WTO, and what it shows is that basically from the production location to the destination, let's say in India or elsewhere, the cost of trade, that is the total cost of logistics, moving the merchandise, delivery and so on, is up to 300% the value of the merchandise. So a key issue for Africa's competitiveness and actually growing its trade is the disinflation of these costs, that is to cutting these costs. And what we heard from the minister, as well as what we see also happening in terms of digitization of trade, of the trade process, that is passing the border or using the digitization in trade finance, reducing the financial cost of moving the merchandise, or reducing the logistical cost of holding the merchandise in warehouses, and so on, is so important for the growth of trade in Africa and its competitiveness.
And what other, perhaps, Mark, other kind of investments that are going to need to take center stage? I mean, the minister spoke to infrastructure being such a backbone of trade, but what are other investments that we can look to that are going to be pertinent?
Trade finance, we love this subject because if you read a little bit the WTO literature, we've been, I think, some of the precursor in making people realize that trade finance was not only a demand-driven business, that is, the amount of trade finance available is not only a function of the amount of trade, but the supply of trade finance was also having an impact on how much trade you do. And actually, we did in 2023 a study of ECOWAS, of trade finance in ECOWAS. We actually have been quantifying the market. And would you know, for example, that only 25% of trade of the 4 largest economies in ECOWAS, Nigeria, Senegal, Ghana, and Cote d'Ivoire, is being supported by trade finance, while the average globally would be about 60%. So the potential is immense. And so we've done what we call a counterfactual calculation, whereby we said how much more trade would we have if we increased this 25% to the average continental level of 40%. Well, you would have every year 8% of trade additional to what is currently happening. So you would essentially increase trade in the area of ECOWAS for about $20 billion a year, and this is already massive. So please invest in trade finance, make it cheaper, make it more available, you will have more trade.
Absolutely. I want to stick to this concept of inter-regional trade. Mark has alluded to ECOWAS and the impact that we've seen to the region like ECOWAS. But Gabrielle, what we've also seen is the Global South also consolidating, whether it's the whisper of an alternative currency to the US dollar, but we've also seen the significant impact from a trade perspective that nations like BRICS have been alluding to. I mean, China, India has already been mentioned quite a few times. Talk to us about the economic activity and the value, or rather the impact that can bring should we not only get it right, but continue to invest in it.
Thank you. Firstly, I just wanted to comment on something Atul said. I think you're absolutely right. There needs to be a bit of a bridge in the gap between what the numbers are telling us and realities on the ground. And, doing the legwork, boots on the ground is really needed to understand where those barriers actually lie. And to that first point, Africa is not a country. There's a lot of diversity across the continent, and I think that needs to be better understood to really unlock those opportunities. But to your point around sort of what we're seeing from a Global South trade perspective, and sort of I'll touch on payment systems as well. I think that there's sort of two central themes that we're looking at from a very sort of high level. The one is the potential transformation of payment systems, and I think there's been a lot of conversations around alternative to the US dollar, but then also the sort of subsequent deployment of economic activity from new trade flows. And I'm going to start with that point first, because I think it really demonstrates that South-South collaboration that we're seeing. It's already happening, and the China story has been one that's got a lot of headlines over the last decade, but it's really, it demonstrates just how far South-South collaboration, BRICS, has really come. I did a sort of a comparison in preparation for this panel on US-Africa two-way trade versus China-Africa two-way trade, especially given all the noise that's coming out of Washington at the moment, and some of the concerns we have around things like AGOA and the likes. And in 2023, US-Africa trade was sitting at about 67 billion. China-Africa two-way trade was sitting at 280 billion. It's just, the transition has happened, the diversification has happened. So those new trade flows, they are already established. At the same time, we've got new players entering the field. And, I mentioned the UAE earlier, but they really are a really useful case in point here. Looking at their non-energy trade figures on the continent, what we saw back in 2012 was sitting at around 20 billion. 2023, it was sitting at 60 billion. That sounds to me that they're playing in a similar field to the US at the moment on the continent. And I think that just again demonstrates that there has been a diversification of trade partners. Some of that is South-South, some of that is BRICS, but I think it goes beyond that too. I think that this will open up new opportunities for Africa to really leverage, but African countries need to be ahead of the game when they do this, right? I think we're faced with an opportunity where we can really negotiate new terms around economic value as opposed to sort of legacy relationships. And now's the time to do that. That's not to say the Western partners aren't important. I think diversification is not one or the other, it's one and the other. And, Western players still have a very big part to play. The G7, we know that they're still the biggest contributors specifically in terms of development aid on the continent. Outfits like the International Development Association, for example, continue to commit more than 70% of their output to the continent. And that is very much needed. And I actually wouldn't discount the US here totally either. I think, AGOA, whatever shape and form it takes post the November negotiations, will be critical to a number of African countries on how they open up trade opportunities to the US. And, I think there is a lot of uncertainty coming out of the Trump administration, but before we entered 2025, there was a lot of consensus around commitments for initiatives like the Development Finance Corporation, for example. Just last year, they signed off on 12 billion investments across, I think it was 140 deals in 44 countries. So, those outfits, they're still available to be utilized. Yes, there is uncertainty, but there could be opportunity as well. To the point around the payment systems, will we see a move away from the US dollar? I think what we are seeing, and what is a good sort of aspect of this, is we're seeing specifically BRICS, but the Global South more broadly, using this as a movement away from the US dollar to really settle payments in local currency. And that has an advantage. Obviously, it can open up regional transactions. It can also lower currency risk on transactions, which is a good thing. I think I'm a little bit more cautious on whether we'll see the introduction of a single currency alternative or a complete move away from the US dollar or SWIFT in a specific region. And I think this is due to various reasons, but I'll flag maybe three of them. The first one is, we talk about these regional blocks, we look at the expansion of BRICS, but what potentially is lacking within these organizations or blocks is consensus amongst members. BRICS is having a great year at the moment. They're getting a lot of headlines, but they really battled to really get agreement in the early days on some of their core pillars. And something like introducing an alternative currency is going to be one that requires a lot of consensus, and that might be a challenge. Then we've also got, and we've already seen, rhetoric coming out of Washington of a possible US pushback if we do see a more stronger push towards a move away from the US dollar, and that has to sort of come into the calculation as well. And finally, a lot of the commentary at the moment is, are we going to see a shift from multilateral trade agreements to increasingly bilateral trade agreements? And I think that puts, an alternative to the US dollar as a sort of collective a little bit in jeopardy. What you might see is a little bit more of one-to-one engagements as opposed to a multilateral agreement on where we're going.
Absolutely. And we are going to delve a little bit into the policy bit of the conversation, because I think that's so important from a regulatory development lens. And before I go to the questions that are on the floor, please do keep them coming. Atul and Julie, I do want to bring you in as the financiers in this group. When we're looking at the investment flows that we have been speaking to and the considerable impact that it can truly make when we're zoning in on the factors that are considerably driving this inbound capital and finance. Where do the financiers set their sights on? Julie, perhaps let me start with you and then Atul.
Okay, thank you. Being a Pan-African bank, I think in EcoBank, we have no plan B outside Africa. So we had to learn how to deal with African uncertainties. We have more than 30 affiliates in Africa. So it provides us a rather good understanding of what's happening locally. Our main drivers in terms of action and financing in Africa is to stay close to the ground and to adapt, to stay agile. And we also try to have a social and environmental impact and to finance real economy. That's why we are very active in commodity finance and corporate finance. We also appreciate infrastructure finance, but we might be facing more constraints due to our balance sheet to be as much active on that floor. And I think that's it for EcoBank.
Okay, so one thing that I want to pick up on, which I think is very important, is the supply of credit. That's exactly at the heart of your question. One thing I didn't mention earlier, and I haven't heard mentioned, but I think is very important in that context, is within the basket of African trade, 30% of that is financed by African banks. And that number hasn't moved in more than 2 decades, while the trade finance gap continues to grow. So other sources of capital will continue to remain critical as we kind of set these ambitions on what more we can do. And I'll try and answer your question and maybe one of these panel questions at the same time. By saying, the way we're looking at it, we see 5 key actors providing financing into the landscape: local banks, foreign banks, DFIs, ECAs, governments themselves. Now, I think what's very interesting is the question you asked, which is how can they kind of work a bit better together, or how can you kind of create a bit of a collaboration coefficient where the the whole is greater than the sum of the parts. And that's, I mean, one of the questions I'll try and pick off. So if I look at foreign banks as an example, foreign banks, DFIs, I had mentioned our engagement with Afrexim, African Development Bank, IFC, but I think what's quite interesting is the potential to package DFI wrapped risk into securitized notes. This is not a securitization for the sake of it, but actually what it will do is enable a much greater redeployment of existing capacity to grow trade finance in Africa. It will importantly bring a more diverse group of institutional and alternative investors to the continent, and it will ensure that, again, you can recycle and multiply capacity without having to try and find more captive supply, through other sources. Another example is obviously in the context of what I call small ticket capex. So at the moment, ECAs are very active in supporting large infrastructure projects. Local banks are very good at supporting SMEs and large corporates up to a point. But there's this gap on what I would call transition infrastructure improvement, which is a bit too big for local banks and a bit too small for ECAs, but which is nonetheless critical to take the SMEs forward in terms of innovation and improvement, especially as we then talk about developing regional value chains. So things like investments in waste to energy, right? So I think there are a number of ways. I mean, probably the most fundamental will be, and I can't remember who mentioned this on the panel, but the partnership that local banks and governments and DFIs can achieve in terms of helping to streamline and simplify and standardize processes. Customs, trade, tax, legal documentation, loan agreements, providing trade assistance funding into SMEs. So there are many ways we can do this, all of them in a way, and I like your term for this, it's not or, it's kind of and, need to kind of happen in parallel to get that going. But at least from our side, that's what we're trying to do, to be part of the solution. And as I say, because of the sheer weight of how much of financing of trade in the continent relies on actors outside of the continent, we'll continue to do our part.
Absolutely, and thank you so much, Atul, for also taking to task one of the questions that has been posed. And I do want to move to the questions that have been set for the panel. Mark, I think I'll take the third question for you, and that is the top 3 things that are required to get intra-African trade to the level of intra-Europe and intra-Asia trade through the use of the AFCFTA.
I will take this one, but just let me say one more word on trade finance, because I think it is such a crucial matter. There was a meeting of the heads of a multilateral organization that was called in by Dr. Ngozi, the head of the WTO, at the fall meeting of the IMF and the World Bank, where all the multilaterals decided to try to bring in supply chain finance in Africa, particularly as supply chains are developing, or as even downstream supply chain provider. Actually, that's where you need the supply chain finance, because the SMEs need to have factoring, they need to have buyers back finance, and so this is what Afrexim Bank will start to develop with Payable platform. We will try to develop also to by the way, map the market in terms of the legislation that is existing. Only 8 countries in Africa have enabling legislation, so we'll do all of that groundwork. We have created a working group. We're not going to be the same. We're going to be working with the private banks through the DFIs, but I think this is one thing we want to do. Now, exactly taking up the question, free trade is a process that is not only moving out the tariff barriers, so that's one thing that the EU has been doing early on, but then the non-tariff barriers, that is very important. All these regulation that needs to be harmonized behind the border. It is a relatively unfulfilling job to do, but it is every single thing about customs valuation. You don't have to reinvent the wheel, by the way. The WTO is providing agreements that allow for international standards to be followed, whether it's border passing, electronic borders, valuation of customs, import licensing, and all of these things that needs to be harmonized from country to country to allow the merchandise in transit to go through, and to even in Europe, for example, we check at the border less than 1% of trucks that are going on here. We know that there's a lot of paper that still can keep truck a couple of days out of the border and or at the border. And so all of this groundwork that is regulatory, again, not very sexy to do, has to be done in order for trade costs. Those think always about the traders, how much it needs to wait for the merchandise. I was in Rwanda not too long ago, and I had someone coming into this one of these trade finance training and ask me, where could I find machinery to do juices? And I say, why won't you do juices? He said, well, I'm an agricultural producer, 300 kilometers from Kigali, but by the time I'm bringing the fruits, it is juices. Essentially, I have to do juices. So I think that if we are going through this process of bit by bit, regulation by regulation, warehouse by warehouse, how to integrate all of these processes into Africa, then you're going to have, it's just not only a matter of regulation, it's a matter of following the merchandise, what it needs actually in terms of the infrastructure and the regulation to get rapidly to the end customer.
Absolutely. And what needs to be true is we need the enabling environment in order for this to actually actualize and to take place. And Gabrielle, this is where I want to bring you in from a policy lens and what needs to be true in the market in order for all of these opportunities that we're speaking to be true.
Certainly. So I'll speak a little bit around sort of individual markets in a bit, but just to follow up on what you were saying there, Mark, I think that there's transcontinental things that need to be taken into account. So I think infrastructure and the investment in infrastructure, everyone is very well aware that there is an infrastructure gap on the continent, and commitments have now been made to bridge that gap. That's good news. But it's going to take some time to, construct those bridges, build those roads, and get those railways up and running. But that is a step in the right direction. I think, cross-border trade is what the African Free Trade Agreement is all about. But when you're dealing with, congested border posts, really a lot of red tape to move from one side of the road to the other, it just is a massive hurdle. And so I think collective efforts, regional initiatives really need to address that so that we can then see that across the continent. So within East Africa, within West Africa, within Southern Africa, we really need to solve those problems at a regional level, and then we can benefit from it across the continent. But if we look at sort of within a country, what do we need? What policies do we need to really unlock this? I think there's maybe four areas that need attention, and I should probably add the caveat: I'm not a policy advisor, but I think it's clear that if you do the legwork in these 4 areas, you'll reap the rewards. The first is really around macroeconomic stability, ensuring that your fiscal and monetary policies are really designed to improve the economic environment, increase certainty within the environment, but ultimately address borrowing costs that are also a massive issue. Again, in preparation for this, I was looking at some of the comparisons, and if we just look at borrowing costs, African sovereigns and African companies, they're borrowing at rates that are 4 to 8 times higher than their advanced economy counterparts. So from the get-go, they're already on the back foot. So I think that there needs to be initiatives taken to really build that macroeconomic stability, build the political stability around that as well, so that we can get those borrowing costs down. I think that would unlock a lot of opportunity. On the point around sort of political stability as well, I think that there needs to be a recognition of resilient governance. So not government, but governance. We need to really have that investment at a domestic level in institutions, so that policies are designed around transparency, they're designed around rule of law. Why? It's important to do that because ultimately that really breeds into investor confidence, and that's really what you want. We had the minister speaking about some of the limitations South Africa has faced around infrastructure and some of the maladministration within that has actually limited South Africa's growth potential there. So really resilient governance and a reprioritization of rule of law. I think harnessing regional trade is been a key theme across the panel. I mean, Mark, you painted a very good picture there around the sort of growth that we've seen on the continent. And, we shouldn't stop here. We really need to focus on that, prioritize that, and hopefully every individual country is asking the question, how do we leverage the Africa Free Trade Agreement for ourselves to the greatest capability? So really unlocking that intra-Africa trade is going to be crucial, and positioning your policy environment to leverage that will be great. What does that mean? It's really around harmonizing your regulatory frameworks, perhaps utilizing the resources that are out there from WTO to really drop those non-tariff barriers to trade in your country and make you more attractive not only to international players but to your neighbors as well, which is really what we want. And then finally, I think, one of the key themes about this panel has been the diversification of trade partners. And I think that can naturally build domestic resilience. And from a policy perspective, you want to be able to balance your economic values, your economic goals with your political ones. And, the theme of this panel discussion was, what is the impact of current geopolitics on African trade? I think from a government perspective, from a domestic perspective, navigating that dynamic between political goals and economic goals is going to become increasingly challenging.
Absolutely. And I do want to take this last question because of time, and I'm going to give it to the financiers in the group, and that is looking at, in light of the projection of circa 30% growth in intra-African trade in just over a decade's time, which sectors and countries are expected to support this, and especially with an unfairly uncertain infrastructure once again coming up, but also manufacturing investment outlook across many markets? Atul, do you want to take that?
Sure, I'll keep it really short, but I think that my view as of today would be that given where we are and what Gabby had just mentioned in terms of the lag time or the lead time to build out some of this critical infrastructure, it will probably consolidate towards the nations that are already dominating trade here today. So, within the continent, and coming back to some of the issues around transit costs and how that embeds in the final cost of goods, one thing that surprised me was that 70% of the continent's GDP sits in 5 countries. All 5 countries are coastal. So South Africa, Nigeria, Kenya, Sudan, Angola. So it's very hard for me in the context of, again, where we are today, the lead time for a lot of this infrastructure build to kind of occur, to believe that it's going to be anything more than more of the same in terms of where that kind of growth or that investment consolidates, particularly, again, given some of the fragility around political kind of structures that Gabby was also alluding to. I think in that context, for the international financing to come in, for investors, be those sovereign wealth funds, asset managers, institutional investors to get comfortable, it's probably going to be a doubling down on what they know rather than exploring new ground, from my perspective.
No, I think indeed it will rely on very few countries. As you mentioned, the concentration of the GDP growth is only on a few countries. So this will be the key, how they will be taking part of the AFCFTA.
Absolutely. And I'll take the last question before I invite your closing remarks. And that is also looking at the non-oil flows from the MEA region. And Mark, I see you smiling. So I'm going to come to you and perhaps Gabrielle with some risk intelligence on that.
No, I just said earlier that a third of African exports are now intermediate goods exports. So that's exactly I invite you to go to the WTO website and look at this very good blog on African trade in intermediate goods, and this is $312 billion, about 1/3 of total exports. And again, as I said, it's going from textiles to metal ferrous goods to fertilizers, car parts, just I would have a long list. So it's true that investors tend to go where they are used to go. They would go for natural gas, they would go for the critical minerals and so on. But I think through the city economy, for example, you see more and more of, supply chain in the construction business, for example, more and more of the cement and glass goods. And it starts with this. It's usually starting with this, like it has started elsewhere. And yet, then when you have a few internationally efficient producers, then they start to go international outside Africa, and so on and so forth. But don't forget how these, global supply chains were done. They were not done in one day. And then you start to see the source of comparative advantage coming in as trade costs go down. Then you start to see that, this place in Africa is good at doing this particular piece of goods. By the way, when Ukraine was invaded, two large car manufacturers who were doing electrical wire had to shift their suppliers to Morocco, where actually these were being done, and they managed to find another supplier in Africa. So this is the kind of things that may happen more and more.
Absolutely. Because of time, I am going to invite Gabrielle, your closing remarks, and then work our way through to Mark. But when we're looking to the nirvana of liquidity, when it comes to us actually actualizing the outcomes of this conversation, what are the questions that we're going to need to pose or actions that we're going to need to take? We have over 700 stakeholders in the room. Many of them are responsible for many decisions in the supply chain of this conversation. So that is the question. That is what we're going and how we're going to wrap up this conversation. 30 seconds to be mindful of time. Gabrielle, I'm going to start with you and work our way back to Mark.
I think it's just, there's going to be a lot of conversations today and tomorrow. And I think it's just making that commitment of what are the actions we're going to take away from that. From this panel, I think it's great to hear that financiers are going to look at the countries that they're comfortable with. But for Africa to really untap its trade opportunities, perhaps we need to be a bit bolder and utilize regulatory frameworks, utilize investment in infrastructure as a way to do that, and have a longer term view here. To Atul's point, the investments are being made today, the reaping of the rewards will happen tomorrow. So relying on what we've always done is probably not the best way forward. So I'd say, maybe be a bit bolder in thinking about trade and trade finance on the continent.
Thank you so much. Atul?
Okay, so I would agree. I think the Continental Free Trade Agreement actually sets out what needs to get done. As with most things, it's about execution and how it's done. So I think having that long-term view, taking a very pragmatic, partnership-driven approach to the continent, and then probably one wish or one ask, and that's through the conference and beyond, is just a discussion on how now more than ever, Africa can be a little bit more self-sustained and selfish in the context of trade. Again, while there is a lot of reliance on international partners, there's a lot of opportunity and a lot of potential embedded just within, kind of the frameworks of working together and closer together within the continent. So that would be my one closing remark and one wish, is just be more selfish.
Be bolder, be more selfish. Julie?
We have been opposing foreign banks and local banks for some time. And I think today we are seeing local and foreign banks converging in financing the gap. So that's a very good thing for the trade in Africa. And maybe another point which has not been mentioned is the role of credit insurance, private credit insurance. Today it's easier to cover and to insure a credit risk in Africa from Europe than when you're located in Africa. So maybe there's a real area for growth there, and to clear how credit insurance can be active for African banks, of African corporates, and how it will be treated on a regulatory point of view.
Fantastic. Mark, round us off.
Well, I've seen in my career the whole world of trade and the geography of trade completely changing towards emerging markets. If you take all countries that represent less than 2% of world trade, so the You would think the smaller one, but that includes my original country, my native country, France. Now, it represents 55% of world trade. Think of that. So the middle powers are becoming the powers. That's very important. Of course, you have the big guys, and they may be fighting from time to time, but you have the middle powers that do not necessarily want to be aligned to anyone, but wants to trade and develop and diversify, and this is exactly what's happening today.
Absolutely. Thank you so very much to our panelists. Might we give them a round of applause, ladies and gentlemen? Thank you so much as they de-stage for their incredible contributions to this conversation. And I think it's going to serve as one pitch deck that we can continue to use throughout the many other themes under this umbrella of looking at how do I identify the opportunities that are going to affect this ever-evolving trade landscape.